Good morning and welcome to UGTP. Before we settle in, here are the headlines moving the next 36 hours. Oracle quietly confirmed it has cut about 21,000 jobs, roughly 13% of its workforce, over the past year, disclosed in an SEC filing. Samsung claims the industry's first and fastest UFS 5.0 storage, with sequential reads up to 10.8 gigabytes per second. On-device storage racing to keep up with on-device AI. India is reportedly preparing to disburse roughly 71 billion rupees in semiconductor incentives next fiscal year to grow its local chip supply chain. Energy Fuels struck a $1.9 billion deal to buy German magnetics company VAC, aiming to build a complete mine-to-magnet rare earth supply chain. And Gartner now expects global semiconductor revenue to top $1.3 trillion this year, with AI chips making up roughly 30%. Those are the headlines. Now, the story behind the story.
Powered by artificial intelligence.
I'm your host, and this is UGTP, the calm, clear breakdown of what's happening across artificial intelligence, computing, and energy. Today is Wednesday, June 24th. The single biggest story of the week is a market event, a global sell-off in AI and semiconductor stocks that some are already calling Black Tuesday. It started in Asia. On Tuesday, South Korea's KOSPI index fell nearly 10%, its worst single day in more than 3 months, so violent that the exchange triggered its circuit breakers twice in one session. The pain spread west with the sun. Japan's Nikkei dropped 3.5%. Europe's Stoxx 600 tech index fell 3%. And by the time New York opened, the Nasdaq 100 had shed more than $1 trillion in value before paring some losses. The damage was concentrated exactly where the gains had been. Samsung and SK hynix each fell about 12%. In the US, SanDisk dropped 14%, Micron 13%, Western Digital 8%. AMD and Intel each lost about 8%. Even Nvidia finished roughly 4% lower. Here's the part to hear clearly. After a run like this, a sharp pullback is not unusual. The semiconductor ETF was still up around 100% for the year, even after this drop. Markets that rise in a straight line eventually need to breathe. And by Wednesday morning, the bleeding had already slowed. Samsung bounced 6 to 10%. The KOSPI recovered more than 3%. A bruising day, yes. A turning point? Probably not. So what lit the fuse? The spark appears to have been a single, specific fear that the hottest corner of the chip market, high bandwidth memory, or HBM, might be cooling just a little. Reports surfaced that SK hynix is scaling back the pace of its next-generation HBM for expansion and shifting resources toward conventional DRAM. Meanwhile, rival Samsung's HBM4 sales reportedly crossed the $1 billion mark. The narrative flipped overnight. There's a deeper story, too. TSMC has reportedly cut output of older 28nm chips by more than 25% this year, redirecting capacity toward the advanced nodes that feed AI. Analysts even have a name for the side effect, memflation. The read-through. The AI build-out is so intense it's now cannibalizing the rest of the chip industry. That's a sign of strength, not weakness, but it's also why these stocks swing so violently. From chips to the software they run. For the first time, ChatGPT is no longer the majority choice among the world's AI chatbot users. According to Sensor Tower, ChatGPT's share of global users fell to 46.4% by the end of May, the first time it has dipped below half. Gemini now holds 27.7%. Anthropic's Claude has climbed to 10.3%. Claude's momentum is striking. One dataset showed it growing more than 300% in a single quarter, converting free users into paying subscribers at about 13%. But keep perspective, ChatGPT still has roughly 1.1 billion monthly users and still leads on raw scale. What's happening is that the market is maturing. People are comparing, switching, and choosing the right tool for the job. That's healthy competition. A quieter but telling story. Bloomberg reports Qualcomm is in advanced talks to acquire Modular, an AI software infrastructure company, for around $4 billion. Qualcomm built its name on silicon. A modular acquisition pushes it decisively up the stack into AI software and developer tooling. The next phase of AI isn't just about whose chip is fastest, but whose ecosystem developers want to build on. Here's a headline that sounds seismic, but comes with a big asterisk. Apple is turning to Intel to manufacture some of its chips. The catch is timing. Apple would likely use Intel's advanced 14A process, not expected to be available until 2028 or 2029. Even then, Apple would probably test Intel first on less critical components before entrusting it with flagship silicon. The motivation is simple. Apple's supplier, TSMC, is so overwhelmed by AI chip demand that supply constraints have held back iPhone sales. Apple wants optionality. File this one under strategically important, but years away. If the sell-off was near-term nerves, this next story is the long-term fire beneath the market. South Korea's government is in active talks with Samsung and SK Hynix over the next phase of massive semiconductor investment, and an announcement on a new chip cluster is expected soon. A presidential advisor described the demand for chips as exponential and explosive, and said the country may accelerate construction plans by more than a decade and begin scouting a second megacluster. But building bigger fabs runs straight into a physics problem: heat. This week brought an elegant potential answer. Researchers at KAIST embedded liquid cooling channels directly inside a silicon chip. Using nothing more than room temperature water, they kept the chip below 100 degrees Celsius even under extreme heat generation exceeding 2,000 watts per square centimeter. It could become a foundational cooling solution for the AI compute era. All of that computing needs electricity, and the grid is feeling it. Britain's grid operator, NESO, issued a rare summer power supply warning for Wednesday evening. To close a gap of about 1.9 gigawatts, NESO was expected to pay around £10 million to fire up gas plants. In the end, it secured about 1.7 gigawatts of imported power from the continent at roughly £1,400 per megawatt hour, nearly 20 times last June's average. The lights stayed on. But it's a vivid illustration of thinning margins. Heat waves push households toward air conditioning, while data centers and electrification stack new demand onto an aging grid. Expect more of these warnings in more countries in the summers ahead. The solution to strained grids increasingly is storage. In Munich, the battery giant CATL unveiled what it calls the world's first real-world validated sodium-ion battery storage system, the Tenor Sodium. Why sodium? It's more than 1,000 times more abundant than lithium and found on every continent, cheaper and more resilient storage. CATL puts it simply: sodium and lithium will be the twin foundations of future energy storage. The numbers are serious. Each module delivers more than 30 megawatt hours. The system is rated for 15,000 charge cycles, a service life of 25 to 30 years, and holds over 92% of its capacity even at minus 20 degrees. CATL plans to begin delivering in China this September, targeting 1 gigawatt-hour of shipments by year-end, with global deliveries starting next June. This isn't a lab demo anymore. It's a genuine new tool in the grid storage toolbox, quietly hopeful news. So that's the shape of the last 36 hours, a market that caught its breath, an AI assistant race that's finally getting competitive, and an energy system quietly inventing its way toward resilience. If this helped, subscribe so tomorrow's breakdown lands in your feed. Drop a comment on the story you want us to go deeper on. I'm your host. This has been UGTP. Take care of yourselves, and we'll see you tomorrow.